Quick headline. Capgemini announced it will sell a U.S. subsidiary after reports that the unit signed a multi-million-dollar contract to provide skip tracing services to U.S. Immigration and Customs Enforcement. French lawmakers and civil society raised immediate alarms. What's your read on this?
It's a classic reputational flashpoint. The reporting showed the subsidiary was paid large fees and tied to performance bonuses to locate targeted individuals, a model that triggers ethical and governance questions, especially in Europe, where public sentiment around immigration enforcement is sensitive.
Right, and France's MPs formally demanded explanations. Do you think this was more a governance failure or a misalignment between the parent company and the subsidiary's customers?
A bit of both. Large consulting firms often let local units pursue revenue, but when the work touches surveillance and enforcement, it clashes with corporate ethics in national politics. The swiftness of the backlash suggests Capgemini judged the reputational risk higher than the revenue, so they're divesting to contain damage.
Could this ripple beyond Capgemini? Will other tech firms rethink similar contracts?
Definitely. The story amplifies scrutiny on how tech is used in immigration enforcement. Reporting shows ICE has been contracting multiple firms. Expect tougher internal review gates, more public disclosure, and pressure from European regulators and lawmakers. Companies will weigh short-term revenue against brand and regulatory exposure.
A sober reminder that technology choices are often political decisions. Switching gears to markets, the big tech-heavy earnings week just wrapped with some sizable stock moves. Verizon and Sandisk ended the week strong, and investors are turning their attention to January jobs data and heavyweight reports from Alphabet and Amazon. What should tech teams and investors be watching this week?
The main point is cadence. We just had a concentrated burst of results that recalibrated expectations. With Alphabet and Amazon coming up, along with the jobs report, investors need to prepare for both company-specific surprises and macro shifts. Jobs data will influence interest rate expectations, which directly affects multiples for growth names.
We've also heard about the so-called Warsh fallout. How does that feed into positioning?
Any high-profile comments that move policy sentiment can change market tone quickly. Traders will balance near-term earnings beats or misses with broader macro cues. Practically, that means hedging for volatility, being selective about exposure to cyclicals versus secular winners, and monitoring guidance language more than just headline numbers.
So it's an active week. Earnings catalyst plus macro shocks. Keep the risk model warm.
Exactly. And for engineering teams, expect analyst questions about cloud margins, ad recovery, AI spend, and guidance cadence to dominate calls.
On to Apple. Shares climbed after stronger than expected results, and coverage shifted towards supply dynamics and Apple's AI positioning. You called this a signal, not just noise. Why?
Apple hitting numbers matters because it validates demand resilience and services monetization. But the market reaction tells us something else. Investors are now dissecting supply chain trajectories and how quickly Apple can fold AI into products and services to drive the next leg of growth.
Analysts are debating Apple versus Meta as a top Magnificent Seven buy. From a tech perspective, where does Apple's edge lie?
Apple's strengths are hardware-software integration, a sticky services ecosystem, and massive installed base. If their next-gen AI features are on-device or tightly integrated with privacy controls, that could be a durable competitive advantage. The usual caveat is valuation. Some pieces recommend buying while flagging near-term supply or growth risks.
In plain terms, good results, intriguing AI runway, but watch supply and valuation.
Exactly. For investors and product teams, the questions are practical. How fast will Apple scale AI features? What chips and supply constraints might limit rollout, and how will services monetize those features? That will drive both stock and roadmap moves.
Pretty soon, every feature announcement will come with a press release and a model number. And finally, Jim Cramer's quick takes made headlines. Bullish on Micron, Robinhood, and Sandisk. Cautious on Lithium Americas. How should engineers turned investors digest this kind of rapid-fire advice?
Treat short-form punditry as a conversation starter, not a playbook. Cramer's calls point to themes: semiconductors pricing power, retail trading platforms recovering, and storage beneficiaries. But they don't replace due diligence on fundamentals, catalysts, or balance sheet risk.
Any examples from his calls we should highlight?
Sure. He called Micron's pricing power absurd, which underscores the current favorable memory cycle dynamics. Bullishness on Sandisk and storage ties to secular demand for flash. And Robinhood gets a platform and product recovery vote. On Lithium Americas, the caution flags project and commodity risk. It's speculative until you see real production clarity.
So, actionable signal or entertainment value?
Both. Use it to spot sectors to dig into, not as a trigger to buy without a thesis. For tech leaders, the takeaway is similar. Headlines move attention, fundamentals move value.
Nice. Succinct, sensible, and mildly caffeinated. That's our show. Thanks for the insight and the wit.
Anytime. Until next week, keep your models clean and your ethics committees awake.
The preceding audio summary was created at jesterengine.com, where you can find and verify the original sources.